Go!
Hi, welcome to Maltbie's Minute on the Market. I'm Robert Maltbie. This is our mid-July market update. Hopefully you're getting into the swing of things this summer as travel is back, the economy's reopened, pandemic looks like it's in the rearview mirror, etc. And I'm sporting my 80s retro up collar looking attire in the spirit of the season. It seems like it's been about that long since I've been out there traveling around. So let's jump into it. We have a bear market. Everyone knows. Everyone's on the sidelines. Everyone's looking for those signs of timing, and the market finally showing that it has priced it in. And so that's kind of the theme here, is pricing in the impending recession. Some analysts think 50% chance in Q1, 30% chance in Q2. Market should come down. The S&P targets 3,400 over at this shop, and it's 3,000 over here. So a lot of pundits trying to one up one another to be the one that kind of picks the bottom. Good luck with that. It's kind of a tough game, a fool's errand. It was Paul Samuelson, renowned 60s economist, that said, economists have correctly predicted 9 out of the last 5 recessions. So it's a tough game to play. And we have the Atlanta Fed right now calling a 2% GDP decline, which would mean that statistically we are in a recession. Let's jump into the indicators. Just going to do a quick high-level analysis and then jump into an idea of the month. So market sentiment is positive. Things are so bad, people are so negative. It means it's positive. I won't go into many more details there. The technical indicators are negative. Market, every rally we get is met by a lot of selling. And the major market indices, the S&P, the Russel, the Nasdaq, all in downtrends, trying to break out of that. They haven't done that yet. We really need for that to happen. Liquidity, however, remains mildly positive. There's just a ton of capital on the sidelines, about $4.6 trillion. And capital inflows have stopped into mutual funds, which is a good sign that speculative aspect stopped. And the IPO market is all but dried up. Valuations, unfortunately, have gone negative recently based on interest rates increasing, making the earnings flow from the market much less attractive. Even with the recent decline in the market, valuations are still a little bit elevated relative to indicators like GDP, and indicators like replacement value, still elevated. Trading at about 19 times earnings, still, we think, elevated there too. Maybe 10%, maybe we should be at 16. We'll have to see. Earnings momentum also negative. The estimates for the year have been chopped from 11 down to 5. And we have earnings season. So in the next couple of weeks, we will see. We will possibly have some ideas of where this market might be bottoming based on the guidance of companies. But right now, estimates and revisions are negative. Monetary indicators are neutral. With the hike, if the Fed follows through for the indicated 75 basis point increase, that will push us definitely into a negative, very tight monetary environment there. So you sum it all up, bear market says keep the powder dry, wait for the signs. We're all looking for the same ones. Shore up your portfolio with high quality dividend payers. Want to get to our idea of the month, and it's a counter trend idea and a counter environment idea, but it's one of those things you have to do in times like these. The name of the company is Alliance Resource Partners, ticker ARLP. Trades about 18 and a half. Our target is 26, and 7% dividend while you wait. So it's about 40% total return potential. Here's what they do. They're a diversified natural resource company. They provide coal to utilities and industrial users here in the U.S. Coal's experienced a crushing, like a lot of resources are, demand right now. Embargoes from Russia mainly are causing a lot of this, and more usage of natural gas and electricity all benefits coal. This company and the coal industry is on track for a net zero usage in about 30 years. We'll see if that actually happens. That's a long way. We're just looking at this for the next 12 months. This company, killing it, EBITDA up 60%, revenues up greater, over 100%, as you might guess, with demand up so much. The key driver, again, the EU proposed ban on Russian coal, and Germany's already gone ahead and done that, and that's 45% of the total amount of coal imported there. So that benefits possibly U.S. companies. Looking at their valuation to their comp group, they're at a big discount, about 1.9 times book versus 3.3, and the risk is the EU doesn't follow through banning coal, and that looks like a virtual certainty. So getting dirty. Santa might also have some coal for stockings around the world for some of those nasty players that have been bad to us. So that's ARLP. Thank you for joining us. Visit our website, singularresearch.com. We are doubling our coverage, taking advantage of what we believe are the most attractive valuations we've seen in small and micro caps since the last crushing bear market in 2009, 13 years ago. So that's singularresearch.com. Sign up for that free trial and get that idea flow and some ideas that 12 months from now will make you feel really good. All right. Thank you. Have a great summer.